Okay, so you've managed to save up 1 lakh rupees to invest this year. First off, that's fantastic. But now comes the big question, the one that really counts. Where do you actually put it? Let's get right into it and break down a clear, no-hype blueprint to answer that for you. You know, this is the exact spot so many of us find ourselves in. You have this chunk of money, and honestly, the plan you make right now is the difference between it growing into something really meaningful or just getting eaten away by inflation. So, let's build that plan step by step. And here it is. Boom. The whole strategy right up front. No need to wait. We're looking at a really balanced portfolio here. 55% goes into equity for growth, 25% in debt to keep things stable, 10% in gold as a safety net, and then 2 really crucial 5% slices, one for your skills and one for your retirement through the NPS. We're going to unpack every single one of these, but first we have to lay the groundwork. Look, before a single rupee goes into an investment, we got to make sure your financial house is in order. It's just like building a real house, right? You absolutely have to start with a solid foundation. These next few things are that foundation. These 3 are, well, they're completely non-negotiable. Seriously. First, an emergency fund. Why? So you never, ever have to sell your investments when the market is down. Second, wipe out any high-interest debt. Think credit cards. That debt is a hole in your bucket, costing you way more than your investments will probably make you. And third, health insurance. This protects everything you're building from being wiped out by one medical emergency. Once these are sorted, you are good to go. All right, with our foundation rock solid, we can finally start filling up those investment buckets. Let's dig into how each piece builds out our portfolio, kicking things off with a real engine of growth. Okay, this is where the magic of long-term wealth creation really happens. This 55% chunk is designed to beat inflation and then some over the years. The plan here is smart but simple. You mix low-cost index funds, which basically just mirror the market like a Nifty 50 fund, with a couple of active funds where a pro manager is trying to outperform the market. It's the best of both worlds, really. Now, think of your debt bucket as the anchor for your portfolio. If equity is the big sail catching the wind, debt is the heavy keel that keeps the ship steady. When the stock market gets all choppy, and trust me, it will, this is the part that acts like a shock absorber. Things like the Public Provident Fund, or PPF, are super safe and have great tax benefits. Or you could look at liquid funds for that same stability but with much easier access to your cash. And now for the portfolio's insurance policy, gold. It's a hedge, which is just a fancy way of saying it's there to protect you. Gold often does well when other investments are having a tough time, so it's a fantastic diversifier. And please, forget the hassle of buying physical gold. You can go for sovereign gold bonds, SGBs, which actually pay you interest, or gold ETFs, which are just as easy to buy and sell as any stock. So we've covered the usual suspects, stocks, debt, gold, but there's one investment in our blueprint that has the potential for a return, an ROI that nothing else can even touch. That final 5%, or 5,000 rupees, is for you. It could be an online course in a new skill, a professional certification, a few game-changing books. Whatever it is, investing in yourself is without a doubt the most powerful wealth-building tool you have. End of story. And here's what that looks like in real money. A 5,000 rupee course in some high-demand skill could easily lead to a 50,000 rupee jump in your salary in just 1 year. You know what kind of return that is? That's a 1,000% return on your investment. No stock, no bond, no thing on earth can compete with that. You are always your greatest asset. So, we've built the portfolio, but what does this actually mean for you down the line? Let's take a look at what happens when you put this plan into motion and just let the most powerful force in finance do its thing: time. The second you set up this blueprint, your money stops just being money. It becomes a little army of employees working for you around the clock 24/7, building your wealth even while you're sleeping. And here it is, the magic of compounding in action. Based on a pretty reasonable average return, that 1 lakh rupees could more than double in 10 years. But just look a little further out. In 20 years, it could be over 5.5 lakhs, and that's without you adding another single rupee. This just proves the secret isn't timing the market, it's your time in the market. So, after all this, what's the big idea? What's the most important thing to walk away with? It's not a secret stock tip. It's about a complete shift in how you think about your money. This is the question you have to ask yourself. You work hard for your money. A smart, balanced plan like this one makes sure your money finally starts working just as hard for you. This blueprint isn't just a strategy. It's a tool to take control of your financial future. The best time to start was yesterday. The next best time? It's right now.